Today's video is my favorite topic, which is financial investments. Just to be clear, I'm not a financial advisor. I have no financial certifications. I am not a lawyer, and this is all my opinion of how I made a substantial amount of money and have given advice to my kids as well on how they should do investments and how I would like them to continue investing my capital if for some reason I'm unavailable to do so. So, starting in the top left are treasury bills and federal savings bonds. Typically, people in my situation or individuals would not invest in these directly. Large companies or large countries like China or Japan or something may buy up huge amounts of these treasury bills in order to have money within the world's primary currency, so that they can buy oil and other uh, types of goods and services based on the most stable world's reserve currency, as opposed to individual investors who are trying to get large investment returns. Banked up bonds, certificates of deposit, and savings accounts. I have done a high yield savings account myself, but other than that, I have not done the top two because the returns are nowhere near what I'm looking for. A savings account, I did a high yield savings account. I still have a high yield savings account as my emergency account with a couple of grand in there at I think a 4% interest rate, just so that in case something comes out of nowhere and I need money quick, then I can take that out in the 5 days or so it takes to get all of my or the amount of stocks I need sold on the stock market and back into my bank account. So stocks will get sold quickly, but this will get me, I can write a check immediately that day. State bonds, I've not done. They all look pretty low. Corporate bonds, if I were to invest in these, which I sometimes do as part of a larger investment scheme as I'm getting older, is to do an ETF, which is an exchange traded fund, which is a full index of a large number of stocks, creating a diversified portfolio. It's a lot of words. In other words, you're taking, say, you're buying a small piece of 500 different companies by buying just a single stock on the stock market. That's essentially what it's saying. So if you bought an S&P 500 index, which would be called SPY, sometimes labeled the spider, that means you get the top 500 companies in the United States. You get a small portion of each, to make sure that if one goes out of business, you'll still be fine because you have investments in the other 49 or 499 as well. Same thing for stocks. Stocks used to be that you could only trade through a stockbroker, and they would take a certain commission, 1 to 2% per year. However, with the invention of mutual funds and ETFs, you're now looking at very small um, yearly fees. Um, I haven't looked recently, but when I did invest in some of this stuff, it was like 0.4%. I've heard it's even lower than that now, so I'll have to look in terms of the next video that I do on retirement. But if you're under 40, um, I stay in this realm here. Um, where specifically, well, we don't need this anymore because we don't have stockbrokers that we have to trade with. We can do it electronically. But the looking at 10% mutual funds, 10% returns on ETFs. And then target date is what I've done for both my kids for college, and I've also in the 529 plan, and I've also done it for myself in a 401k plan. And then if you are fortunate enough to be stinking rich, you can do certain hedge funds and trust funds, which have oftentimes you can't even get into the fund unless you have at least $100 million. And these things, maybe it'll be like 50 families in the United States or across the world to combine to buy more than just stocks. They'll buy small companies, medium-sized companies. They'll buy companies all around the world. They'll buy reverse indexes, which means if the general stock market goes down, then these types of stocks go up. They'll buy rental properties. They'll buy properties across the world. They'll buy just gold and silver and just like diamonds, everything you can think of that possibly could be worth money, and they'll put it all into one hedge fund and make sure that no matter what happens in the world, they stay rich. And then a trust fund is essentially the same thing, except it's for the rich people's kids. And that's essentially how we're taking that I've been running my finances in terms of mutual funds. This is where my 401k goes because 401ks are managed by a mutual fund company. ETFs you can buy directly on the stock market, which let me buy for both my kids' college plan as well as my own Roth IRA plan. And then target date ETFs have also been good for my kids' college fund as well as my retirement fund in my Roth IRA. So those are the primary ways that investments um, are made, as well. And then just over the last 100 years, we've got the inflation. In recent years, we've been getting our butt kicked real bad. Inflation is the amount that prices increase over year. So every year things are getting 3.2% more expensive. So if you invest in government bonds and you're only getting 3.4%, then really you're only increasing 0.2% over the amount that goods have increased. So you're not barely making any money at all. So you really want to try to go down to the lower levels because here you'll end up getting 7%. So you're getting richer every year that you leave your money within an ETF. You're just going to keep getting richer and richer and richer and richer compared to inflation, um, which is awesome. That's the best you can do. And that's it for this video. Thanks.